Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In each episode, we cover all things from the world of trading and we answer your burning trading questions.
We do indeed.
We're back.
We are indeed. What have we got this month?
So this is off the back of another episode that we've done where we were talking about backtesting. And I mentioned the fact that I think this would make a good episode to delve into a little bit more detail. So the title of this subject is The Risks in Backtesting. Yes.
Backtesting. Okay, so we're not talking about the advantages of backtesting here. We're talking about the risks of backtesting. We know the advantages of backtesting. They give you a template and a trade plan, essentially. Once you've built it all up, they give you rules, entry rules, stop loss rules, target rules, trade management rules, all of that. That's great. So what are the risks? This is what we're talking about. What are the risks therefore, of backtesting? Well, one of the biggest risks with backtesting is that whatever you've done is tested on historical data, and the markets are a constantly evolving thing. And going forwards, there's not a guarantee that the same sort of market movement is going to happen going forwards. And this is why so often we come across traders who say, I did all this back testing, did years and years of back testing, and then I started trading it and it just lost me money. And that's pretty common out there. So one of the risks, and then I'll put it over to you, one of the risks of back testing is that people curve fit too much.
Yes.
So they curve fit, they might have the overall pattern or whatever it is might be fine. The concept may be fine, but then they start tweaking it and they're like, so I'm going to look for a 1.2R target and it needs a 0.8R stop loss or whatever. And it's so tight. And if it doesn't, that works well in the back test. But in reality, as the markets start moving around, it's just not going to work. So they curve fit it too much to the stop losses, to the targets, all those sorts of things. The more simple the back test, the better.
Like that. I think, and this is for anyone listening, who hasn't done any back testing. This isn't a reason to say, there's no point doing it.
No.
But I think fundamentally what I've seen is traders going through a process. So they don't do any back testing. They may have some sort of loose strategy that they trade. They lose money. Now they may have lost money because the strategy doesn't work, or they may have lost money because the strategy works and they haven't been able to deliver on it. But either way, they then sit there and go, do you know what I need to do? I need to do some back testing. So off they go, do a ton of back testing. And I think one of the reasons back testing fails is actually it's psychological, is because the trader thinks because they've back tested, they've now almost earned the right to be successful and profitable, because they say, look, all this data I've got, or I've put in all this hard work, I've put in all this effort. But just because you've back tested doesn't mean you therefore now stick to your rules. It doesn't therefore mean you're not susceptible to the emotions. And like you said, it doesn't mean that going forward over the next 3 months, 6 months, a year, you're going to get the same results. Because too many traders will think linear. They go, well, it makes me 8% a month for the last 3 months, and then you trade and it makes you 1% a month for the next 3 months, and you go, well, it's not the same. Well, nobody said it was going to be the same, and you shouldn't necessarily be immediately rewarded for this hard work you've put in. So when you combine the psychological issue of thinking that because I've done this, I'm now going to be successful, bearing in mind the fact that they potentially have curve-fitted the data and fiddled around with it, or not been accurate through their backtesting, it can actually almost do the trader more harm, because they think, well, what's the point? I've done all this work and it's still not working. But actually, they've treated this backtesting data set as the holy grail. They've almost made that their holy grail, rather than looking at it like a framework and saying, okay, over this period of time, the strategy did this. But what were the overall market conditions during that time? Or thinking that, well, this data is great. Look, I've made all this money during this period. If I traded during that time, look what I'd have done. But not thinking that they could have just been backtesting through a sweet spot.
Exactly.
And so many traders will look at a data set and go, this is positive, so going forward it's going to be great. Whereas you take a veteran trader, they'll look and go, that data looks so good that I'm almost expecting it to underperform for the next 3 months, because these last 3 months or these 6 months have been so good. So a lot of it is psychological. It's not this shouldn't then become your holy grail. And that isn't me saying you shouldn't do it, but it doesn't. You shouldn't lean on it as the holy grail of what you trade.
It certainly gives traders a false sense of confidence. It can do. Not every trader is going to be like that, but it can give them a false sense of confidence. And like you've just said, different depends on what the strategy is that you're back testing. Some strategies work better in trending environments. Some are really good in oscillating environments. So again, like you've just said, recognize the period that you've traded your strategy through. Recognize its strengths and its weaknesses. You can have strategies that will work through any market condition. So they'll lose through for argument's sake, for an oscillating choppy period, but then they'll make it all when the trends develop again. So, but if the strategy itself is good enough at cutting its losses and all of that, then it will still overall work. But certainly there are some strategies which are really only geared towards, like you've just said, trendless environments, and that's absolutely fine. But recognize the strengths and the weaknesses. Is this a strategy I can just run through anything and everything and put up with the random distribution of losses and wins and look at all of that historically, like you've just said? Or did I just backtest this for a beautiful trend in dollar yen through 2021 or 22 and not realize that, it's not going to work all the time?
Exactly.
So there we go.
Yeah, I think that's in line with another thing that I see with traders is that they'll look at the data and they'll err to the positive. So they'll go, right, well, it's got a win-loss ratio of 60%, and not think that they may have adjusted the results, but unknowingly they've biased the results. But they don't then go and look at necessarily the drawdowns. So they might go, this strategy's made me all this money, but they don't bother to sift through it and say, okay, what was the longest losing period? Or not assess it from the point of view that they could have got lucky. Their starting point, day X, when they started their testing, they hit a sweet spot. So even though there are losses in there, the overall result is good, and they hit a sweet spot when they start. But they're not looking at the data going, what if I started midway through and the run in the middle was my starting point? So the risk is they look at the overall results and think, great, but don't actually delve into the data and say, well, yeah, starting in July rather than May would have meant I'd have gone into a 5% drawdown from day one. So then when they start trading it live, they're looking at it saying, I'm in a 5% drawdown. They're expecting the sequence, or the distribution, as you said, the sequence to effectively be the same. But your starting point when you start a strategy can just be out of luck. You could hit a bad run and be doing everything right. And if you're comparing that to the overall result on the back testing, you're going to see you're going to be demotivated because what you're achieving over the short term doesn't reflect the results over the back testing period.
I think one tip along the same lines as what you've just said is, although automation is great and you can automatically use automation to backtest, all you end up with is a summary sheet telling you your win ratio. Yes, it will tell you how many wins and losses in a row and all that sort of stuff, but it's just data on a sheet. You're not immersed in that information. There's no substitute for going back, scrolling back your charts and looking at this stuff. And so you see, well, okay, that was a winning trade there, but how did it go about? When it's just a stat and it's just a number, all you know is, it had won this amount of times and stuff. How did the winners go about getting to their targets or however they played themselves out? Because that's what you're going to be seeing when you're trading this stuff. Not a sheet, not an overview sheet. You're going to have to get used to, well, on that occasion, sometimes it meanders and it still gets to the target. Sometimes it goes up a bit, does a deep pullback and then still goes there. All these things, the more you can immerse yourself in the strategy, and that way you'll understand it. Coming back to what you've just said, so when it does go and have X number of losers in a row or goes into a drawdown, then you've experienced that in the back test. Really immerse yourself in the back test. Don't rely on software. Software is great for at least trying different combinations, but then you've got to go back over those charts manually to properly get into how these all play themselves out.
I love that, because it's trading just a set of numbers, because that expectation is related to the numbers on the sheet rather than what you're saying is what's actually going on the trade. And I say to traders that I work with, What percentage of your winning trades go into a losing position before they reach their target? And the majority of traders, before they work with me, they've got no idea because they've not spent the time looking at the chart and not looking and saying, out of these 50 winners that I've had over a 2-year period, most of them go into a losing position before they hit their target. Yeah. Well, if they know that, then they're expecting the trade to go against them rather than being the trader that has had 2 losing trades and then they're in trade number 3, the trade goes against them and then they're emotional about it rather than thinking, well, I'm expecting that to happen. Most of my trades go into a losing position before they hit target. And that's because they're not doing what you're saying, which is looking and spending time on the charts. They're just looking at effectively a printout.
One final thing I'll say there is, although we've sort of already covered it, saying that, is back testing and then having a defined strategy a holy grail. Don't think that a back-tested strategy that you go and start trading is going to remove yourself from the emotional side of trading.
Exactly.
Because like you've just said, you're still going to potentially feel all of that. You still got to work on the psychological side of things, because when your mechanical strategy goes through a period of X number of losses and all of that, you're still going to be feeling it, because I get this, I hear this over the years and people say, oh yeah, but I've got this strategy and I just follow the rule. Yeah, that's great, but don't think that it's going to remove you from the emotions of fear, greed, all of that stuff. You still have to work on that too.
Great stuff. So on to our question for today. So the question is, what is a realistic percentage I should look to make in a year?
Oh,
yeah.
Well,
where do we start?
Again, it's what's realistic to the person. What do they think? I mean, they're asking us, what's realistic. But okay, so let's start off with it depends. Okay, so it depends on how much money you're trading with. So someone who's trading with $1,000 in their trading account is probably looking for a bit more bang for their buck than someone who's trading for $1 million in their trading account. So someone with $1 million in their trading account might be more than happy making 20% in a year. And they don't need to take as much risk to make that 20% in the year, because they don't want to take on a lot of risk because they've got £1 million that they're trading with. So they're quite happy trading with lower risk and a lower return. So because they don't need to be making that much more. Someone with £1,000 or dollars in their trading account may be saying, yeah, but I really want to grow this. I need to grow this more aggressively. So they're willing to take more risk on. So the answer for that person is going to be entirely different to someone who's got $500,000 in an account. When they say, well, what's realistic? Well, I would say, well, what are you comfortable with losing? And then we'll take it from there, and you work out your risk. So someone with a small account is probably going to be looking for more. But coming back, first of all, what's realistic? If you're looking at trading CFDs on things like FX, Forex, stock indices, commodities, gold, silver, the usual culprits, putting aside cryptos, then I've always said that as a retail trader, there's 30 to 50% in a year is more than achievable. I'm not saying it's going to happen. I'm not saying that you can't do a lot more than that. You could undershoot that. But certainly it's achievable, risking the sort of 1% per trade type scenario. So it is achievable to do that. So when someone's saying, well, give me a framework, yeah, there's a framework for you. But it's not to say that you can't do 100% in a year or more, or that you end up doing 15%. It's such a broad, depends on the year, depends on the market. So you take.
Well, I think that I'm going to tag on what you said there, which is that person looking for an average figure? So when you say 30 to 50%, I'm glad you said that, because I would have put it in about the same bracket. But that doesn't mean it's going to be like a cash register that each year you get 40%, 40%, 40%, 40%.
Yeah.
You have to be willing, especially if you are trading less, so your trade frequency is lower, so you're more of a swing or position trader. You might have 1 year that you only do 15%.
Yep.
But the previous year you did 110%. So when you do the 110%, you can't have that as your new expectation. So the sideline to the question is, be careful when you have a good year that then becomes your new expectation. So let's say, for example, you did do 100% in 1 year, assuming you did everything right and risk was all spot on. Don't then expect it to be 100% year in, year out. So don't necessarily change your expectation, because that year might have been unrealistic. It was what you got, but the strategy itself over time has actually got an average that is closer to 30, 40 or 50. So I think that's another thing I see is people have a good year and then that becomes their new benchmark.
Yeah.
And then they feel deflated because they then have a year that's nowhere near that. But actually, if you look at the average, it's all good. So I think that's it. But we can throw it back to what we've been talking about is, well, what's realistic relative to the strategy you trade? Well, what's your backtesting? What's your backtesting showing you? What's the data that you've got in front of you showing you? And I think it's very dependent on how many trades you're placing, the time that you're taking, the risk that you're willing. Like you said, the guy who's got £1 million account could be trading a very similar strategy to the guy who's got a £1,000 account, but he's choosing to risk 0.25% risk per trade. So he's trading in a similar way, but he's choosing to his risk percentage per trade is much lower. Versus you have other people that have got more time and have got more time to trade. So as a result, they're thinking, well, I'm going to trade more. I think another trap that I see is people go, well, I've got more time, so I'll place more trades so I can make more money. And that isn't necessarily a realistic expectation.
It's such a difficult subject, this one, because the reality is you might as well lick your finger and hold it to the wind to see which way the wind's blowing and with regards to returns. So we can say, look, there's some ballpark figures, but in any given year, nobody knows what you're going to make. You follow your trading plan, and in one given year, that, as you've already said, you could go and make 100% or more, and another year you're following exactly the same plan and you make 5%. It really, or even potentially you have a losing year as well. So it's such a wide subject matter, but at least we've sort of said, look, this is what's achievable within those sorts of realms. You could make more, you can certainly make less, but the main thing is make sure you're trading at a level that you're comfortable with. Because there's no point in going trading, like either you're trading too much and then that stresses you because you've got too many positions on, or your trade frequency, as you've already said, is too high and then internally you can't cope with it, or that you're risking too much. The amount of people that just because, let's say, we talk about maybe risking, let's say 1% per trade. Now that might be, and people say that's reasonable and logical, as a maximum risk. And someone might go away and trade risking at 1%, saying, well, I want to trade at 1% because like you say, my back testing and the plan, that would put me in the position to be making X, Y, Z %. And then they go and trade it, but they're absolutely scared every time they put a trade on because 1% risk is still too much. Let's not say that is right for everybody. For someone, it actually might be 1/3% is where they feel more comfortable. If you're not comfortable, you'll trade badly because then you'll start going off plan, moving your stops too soon, banking your profits too soon. All those things that people do is because they're not comfortable. If you're comfortable, you're going to be more laid back and you'll trade better. So, but that might mean that you don't make that elevated return that you would like to make, but you have to, as we've said this before, earn the right to trade at 1%. If that's where you want to trade, but you're not comfortable right now, well, drop it to 1/3% risk per trade right now, and then gradually build up over time as your confidence increases. Earn the right to trade a given amount because you may not be ready for that just at the moment. So there's so many variables here on how much can you make, but it depends on so many factors. But
I like that. I think make your target being confident and being consistent rather than an arbitrary amount to hit to the end of the year, because you could hit 28% for the year, done everything right, traded at a level of risk that's comfortable to you. But if you think that you should have hit 50, you may see that year as a failure when in fact it's actually been a very, very good year.
Yeah, perfect.
Good. On that note,
his name's Ali Crooks.
His name's Charlie Burton.
Trade safely out there.